Well, when it comes to that impact of trade tensions on growth, are we going to see it playing out just yet?
No, probably not yet. I think the second quarter was simply too early. The only thing that we might see could be a sentiment effect, but I even doubt that we're going to see that. So therefore, I think German growth is still more or less set to really outperform the eurozone once again. And if there are any impacts from the trade tensions, we will only see them in the third quarter later this year.
And this, of course, comes at a time where already in sentiment, things like the German IFO, we have seen some people highlight a sentiment hit from trade, the tariff tensions, if you will. So at what point do you think should we be worrying about a real knock-on to the fundamentals? I mean, you talk about it coming out in the next quarter, perhaps for GDP, but do you think it's already putting some investment decisions on hold?
I think it is. When you look back last week, we had industrial orders out for the month of June that were extremely disappointing, sharp drop. And I think we do see that companies are postponing their investment decisions already right now. It will not show up in the second quarter GDP data, but I think going further, July, August industrial data coming out in the next month, I think this will be really the decisive moment in which we can really then assess whether there is a downward impact from the trade tensions or not.
Carsten, no doubt the European economies are keeping an eye on the situation in Turkey like the rest of us. Of course, this isn't relevant to today's data, but I do wonder, yes, we talk about bank exposure in Europe being a concern as it pertains to Turkey, but what about growth, manufacturing orders? Because I did see a report in the Wall Street Journal that already the German machinery exports to Turkey have dropped almost 5% in the January to May period.
They have, but listen, I think Turkey is number 15 on the list of most important export destinations for the German economy. So therefore, it does matter, but it is not relevant enough to really, for example, to stop the current recovery in Germany. And we've seen this so often in the past. Germany is not exposed to a single country, but exposed to many export destinations. So if there is a crisis in one or two export partners of Germany, it does not really matter for overall growth, but it is the series. And of course, Turkey could be the drop in the bucket, adding on to the trade tensions, to maybe a slowdown in China. But just regard isolated, Turkey is not the big issue for German growth.
And what about on the inflation front? We have seen the euro weaken since the latest report when it comes to last CPI estimates here. So what are you expecting in the way of inflation today?
I think, again, stand still, maybe a slight downward adjustment of inflation, because it's still too early to see any inflationary impact from the weaker currency. We've seen also a bottoming out of the energy price impact on inflation. So therefore, the European Central Bank is confronted with a situation in which the recovery continues, not as strongly as they had hoped for, and inflation, which is slightly retreating. So you could even argue that the best of both worlds, which allows the ECB to continue its dovish tapering and therefore allowing them to stop QE by the end of this year.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.